Now you can see the paper.
Yes.
Yes. So you can see the date, and even this is wrong. Even we couldn't held it on 25th April. We held it only August on August 1st. So that's the risk of postponing the exam. You made a request and you think it's a success. I don't know whether it's a success or failure. If anything goes wrong, we may not be able to have it. So however, now it's fixed on December 24th. No, 17th. 19th. Sorry, 19th. Okay, we'll see whether it is possible to have a class on December 12th. We will let you know. Okay, shall we go without wasting time? Shall we go through this day? Okay, first question. We predict that currency A will devalue. So we take a net oversold. Okay, the structure. Let me first again remind you. There are two sections, section A and section B. This would be the same structure this year as well. There are two sections, section A and section B. Section A, there are 40 short questions. You get 40 marks. And section B, there are 5 questions. You have to answer 3 questions. In the section A, again, the question 1 contains 10 sub-questions. What you have to do, state whether there are 10 statements, whether those statements are correct or true or false. Not only that, true or false, you have to give the justification. If it is true, you have to give why it is true. If it is false, you have to give reason why it is false. But don't write lengthy paragraph, just a statement or a sentence or 2 maximum. You should be able to answer the or justify in 1 or 2 sentences. Don't write more than that. That means you don't know the answer. Then from 11 to 40th MCQ questions. There are 4 options. So you have to select the most appropriate answer, the best answer. So that's how the paper structure. After that, we move to the section B. There are 5 questions. You have to answer 3 questions. So each question carries 20 marks. That means for section B, you get 60 marks in total. So this, I'm reluctant to say this is a essay type, maybe a structured type. Even the questions are lengthy or seems it's essay. Again, you no need to write very long answers unless it is especially like this question. This may be, again, you get only 5 marks. So you have three hours to get 100 marks. Then for 1 mark, what is the time that you have to spend? Likewise, calculate for 5 marks, what is the time that you have to spend even to write a sort of a descriptive answer. But most of them would not be, answers may not be lengthy answers. In very short, again, 2-3 sentences, you should be able to give an explanation or for a question, or maybe do some calculations. In calculations, you have to better you show each and every step, write down all those things, then you will get some marks for those steps as well. If you write down only the last answer, final answer, if it is correct, you will get some marks. If it is wrong, you won't get anything. If you show the steps of the calculation, then at key points, you will get those marks. But if you have to use a equation, better write down the equation, then identify what are the variables in that equation or define it properly. Then after that, you substitute numbers, do the calculation, get the answer. If something goes wrong there, still you get some marks. Maybe 60-70% of that allocated marks you will be able to get, even though there's a some errors, calculation mistakes, or in substituting you substitute the wrong number or something like that. That can happen, but you get some marks. So don't write only the final answer. So that's the structure. Any question on that?
So in section A, one mark for one question.
Which one?
Section A.
Section A, yes. There are 40 questions, 40 marks.
So in the structured question section B, if we have written the correct answer without the steps, do we get the total marks or only the marks for the answer?
Only the marks for the answer.
Okay.
And again, the calculator, just check what are the calculators that you are allowed to bring. Only the not the financial calculators.
Non-programmable, right?
Programmable, yes, not programmable. Non-program, it should be an unprogrammable calculator. So get ready with one of those and practice that one as well. Different calculators perform the calculations in, that means the keystroke should be vary depending on the type of the calculator, and your style also change. So vary. So different calculations, try with the calculator what is the easiest way to do the calculation. So you practice the calculator as well. It is also very important, but otherwise you waste your time and you may get incorrect answers as well. The sequence is incorrect, the answer may be incorrect even though you input the whole numbers correct. And other thing is try to use the memory facility available in the calculator. Don't do the calculation one set of calculation and note down the answer again. That if you can use the memory, you can save some time.
So on request,
Yes.
shall we do the section B first, and if we have time, shall we do the
Either way, if all others are agree.
because section B carries big more marks than the section A, that's why.
But the concepts the same. Indeed, I prefer section 1 because it really tests you whether you know that the concept or not. So if you get the concept, know the concept, then section B is not a big issue. Section 1 questions are the two.
Okay. Okay.
But if you want to discuss it, start with section B, we can start then. So shall we start then?
Excuse me, sir.
Yes.
Sir, could you please explain the question number 4 in part B? Only options.
So now you shall we go by one now? Otherwise, no. Okay. We'll start with question 4. This one.
Yes, sir. Second one.
Only part 2. This one.
Yes, sir. Part 2. Calculate the value.
So others. What do you think? You want to discuss the whole question or? Okay, I start with the beginning. That will give some idea of what you should write as an answer. Okay. A company treasurer needs to borrow 10 million euros for 270 days, 60 days from now. Explain the interest rate risk faced by the company treasurer. What is the answer? How long you should have to? How should be the answer? What is the company treasurer is about to do?
Borrows.
He's going to borrow on a future date for a future, another future period. This is what is the product that we are going to discuss. So the treasurer is going to borrow euros or whatever currency, whatever the amount, for a 270-day period. That means for a 9-month period, but in 6 months, sorry, 2 months time, 60 days, 2 months. So this is about forwards, FRAs, forward rate agreements, basically, mostly. It can be a futures also, but however, this is a transaction that we are going to enter in future. So then it can mostly related to forward transactions or forward rate agreements, futures, and things like that. So that's the thing. Whenever you see this sort of statement, you should be able to identify, okay, which subject area, what are the topics that relevant. If you go down, you can see the FRA, forward rate agreement transaction. It's specifically mentioned. So the focus is here, there, on the FRA. Then the question is, first one, what is the interest rate risk faced by the company or the treasurer? What's your answer?
Interest rate increasing?
Sorry?
Increasing, sir? Interest rate?
Exactly. If the interest rate increase in future, the company has to pay or incur high interest expenses. So the risk is increase in interest rate when?
After 2 months.
After 2 months. So that statement would be enough. Oh, enough, not would be. That's enough. That's what I expect. Don't write that this and I have seen the answers. No? So there are maybe half a page answer, but you don't say the correct thing in that half a page answer. You may not get any marks, but those who have written that statement one sentence,
Yes, sir.
yeah, okay, start. Okay, we were discussing this part B. The question is, what is the what is the type of the transaction? FRA transaction. Even the product is given FRA, forward trade agreement transaction. The treasurer should enter into hedge that risk. So this is important. First, we have to identify the risk properly. What is the risk? Then only you can discuss about the how to hedge that. So therefore, you should be able to identify the risk properly, the answer to the first question properly. Then only you can answer the second question, second part. Okay, what is the type of the FRA transaction that you should enter? Whether you should buy or sell, and what are the other specifications? What other terms? Can someone?
Buy a FRA,
Sorry?
pay fixed term.
Sorry, I cannot hear you.
Pay a fixed rate, sir.
Fixed rate.
Yes.
What does it mean by fixed rate?
I mean, I buy FRA.
Yeah, the treasurer should buy a FRA. When you buy a FRA, what do you get?
I get the floating.
Sorry?
I receive the floating payment.
Yes, you receive the floating rate, you pay the fixed rate. So therefore your cost is fixed. If the interest rate goes up in the future, you will receive the floating rate, you pay the fixed rate. That means effectively the difference between the fixed rate and the actual rate, you will get it. So effectively you are borrowing at the fixed rate in the future. But for this question, that part is not enough. That's only a part of the answer. You buy a FRA, but what are the specifications of the FRA? What are the terms? What are the tenors? There's a way that you specify your FRA. You need to buy that exact product, otherwise it won't hedge you.
So 2 by level.
2 by level. Yes, you should buy a FRA 2 by level. What does it mean? The FRA contract, so that will come to effect in 2 months and for another 9 months period, because the treasurer wants to borrow in 60 days. That means 2 months from now or from today, and for a 9 months period. So the total period from today is 11 months, and the borrowing period will be started after 2 months from now. So therefore the answer should be buy a FRA 2 into 11. That would be enough. The answer, buy a FRA 2 into 11. Clear? Any questions? So now you can understand what sort of answers that I expect in these type of questions. No need to do or write very lengthy answers. Any questions? So I hope you can remember what is a forward rate agreement. Can you hear me?
Yes. Sir, only writing buy of and 2 into 11 is enough, no?
That's it. Yes.
Okay.
Shall we move to the second part? Option
Yes.
part. So calculate the value of the following call options. First one is a long call. Strike price is 100. Premium is 4. And the stock price is 90. What is the value? Or is it in the money option or out of the money or at the money option?
So it is out of the money.
It's out of the money. Why?
The market is cheap.
It's a call option. That's first thing that you have to identify. It's a call option. Then the relationship between or the relative positions of the strike price and the current stock price. So the strike is higher than the current market price. So then the call option is out of the money. The call option is out of the money. Then what is the value of out of the money option?
So 0.
0. But yes, it's 0, and that's the answer I expect. But there's a small concern here in the question. I feel it's my mistake. I should have mentioned that assuming on the expiry date. Otherwise, there will be a time value. Then it may be the premium that gives you that value. But when generally when we say value, so on the expiry date, there's no value. If it is before that, if you want to buy this, the value is 4. That's why you are paying $4 as the premium. If you have that sort of doubt, just write it. I assume this, and so this is the answer. So in the second question, it's a short position. That is also important. Call long position and call short position. So now here the value of the option that you have to give from the buyer's perspective. The second one from the seller's perspective, because you are having a short position. Strike rate is the same, premium is the same, stock price is 110. Is it in the money or out of the money or at the money? This option,
So it is in the money.
it's in the money from the buyer's. Oh yes, it's in the money. So then the buyer will exercise the right. So what is the value?
-4.
Minus
-1. The value would be into multiplied into 4. Once 4 -4. So.
-4. How?
In the money value is -1.
-1.
Yeah, because it's in the money, no, sir. And short position.
So the strike price is 100. Stock price, current price is 110.
Sorry, sir. -9.
What is
9
the
plus 9.
what is the amount that you have to pay to the option buyer?
Plus 9.
Plus
9.
how?
So it's a plus 11, minus 11.
What is the amount that the option seller has to pay to the option buyer?
So anyway, he has to pay $10.
Strike price is 100. This is a call option. Strike price is 100. Market price is 110. So what is the amount the option seller has to pay to option buyer?
So minus 10, no sir.
Minus
10.
the amount that's the thing. The amount the seller has to pay to the buyer is 10, not minus 10. Okay.
Yeah, 10. Sorry, sir. Sorry, 10.
The amount they have to pay $10. So as from the value perspective, it's minus 10. Cash flow minus 10. That's true. Then you have collected $4. Then ultimate profit is what is the profit to the option seller?
So that will be minus 6.
It is minus 6. Profit is minus 6, or you can say loss of $6. Is it clear? Others? I heard only one voice. I don't know whether others are following this or not. Are you okay with that? Okay then, shall we move to another question? So you want any more clarification on this?
No, sir, can.
Yes or no? Okay. I assume it's like we can move to the next question. Any specific question that you want to discuss?
Question number 2 and 3.
2 and 3. Question number 2, it's about fixed income and money market. You have purchased 2-year bond with a coupon of 6% and a face value of 1,000 rupees. Coupon payments are semi-annual basis. Required yield is 6.5. Calculate the price of the bond. What do you do? How do you calculate the price? Can one explain in one sentence how do you calculate the price of the bond? it's not the answer for this question. You have to calculate it. But if I ask you, how do you calculate, or what is the price of a bond? How do you write the answer in one sentence?
So discounting cash flows.
Sorry?
Discounting cash flows.
Discount the cash flows. Just maybe 2/3 is correct. That's my missing part in that sentence. Discount the cash flows at
Required rate.
sorry,
Required rate of interest.
required rate of interest. Yeah, that's fine. But specifically in the words given here,
Yield.
Yield, yes. That's the discounted. So what did you say? Discounted.
Discount the cash flows, sir.
It should be the sum of the discounted cash flows, or cash flows discounted at the yield. Or much better way would be present value of the cash flows discounted at the yield to maturity or the required yield. So that's the basic idea. However, you have the basic idea. It is a sum because we have more than one cash flows. So we have to calculate the present value of each and every cash flow and add them together. That's how you do. So then you need to decide what. If it is the price, it is the present value of future cash flows. What do you have to do first? What is the first step?
Calculate the cash flows.
Yes, decide what are the cash flows, the amount, and the what do you need?
Frequency.
Cash flow amount and the time in of the cash flow. You should know when are we expecting this each and every cash flow. So you need the cash flow amount and the time in. Then what you need is the required yield or yield to maturity, which is given. So if I switch, so now you can see the board, is it?
Yes, sir.
Can you see this? It's a 2-year bond. I just noted down, and the coupon is 6% and semi-annual. This is important. Yield is 6.5. How many cash flows?
4.
4 cash flows. What are those? This is at after 1 month, but we can put it as 1, 2, 3, 4. What is the amount? What is the cash flow? PF1. The first cash flow is the coupon at the end of the first 6 months. What is the coupon amount that you receive? Face value is 1000. What is the coupon amount? How do you calculate the coupon amount?
Face value into coupon rate divided by the
Into coupon rate divided by
2.
2 by 2.
Semi-annual.
This is the coupon rate. Remember. In this specific instance, on the coupon rate, coupon frequency. In this specific case, coupon frequency is 2 because it's a semi-annual. So what is the coupon amount? The face value is 1000. Coupon rate is 6%. So 6% in decimal is 0.06 divided by 2. What's the amount?
$30, sir.
Sorry?
30.
30. So you get $30. Is it correct? Each coupon date you get 30 rupees. On the maturity date, the last one
1000.
1030. Why? You get this face value, the maturity proceed plus the coupon. Then what do you have to do?
Discount.
Discount it at 6.5%. So this is the annual rate. Then what's the price? $30 divided by
1.0325.
1.0325.
0325.
What is this 1.0325? It is indeed 1 plus R, but that R should be the yield divided by annual yield divided by the coupon frequency. So the annualized yield is 6.5. It's a semi-annual bond, so we have to divide it by 2. 6.5 divided by 2, it is 3.25. So you make it a decimal point, it becomes 0.0325 plus 1, 1.032. What else? Is that completes the first part? Present value of the first cash flow. Is it correct?
So that is to the power 1.
Sorry?
To the power 1.
To the power
1.
1. Okay. Whether you write it or not, it's okay. Fine. Then you add the present value of the second cash flow. What's the power?
2.
2. Then 30 divided by 1 plus 0, 3. 0325 to the power 3 plus the last one 1030 1 plus 0325 to the power. So use your calculator to solve that. Then you get the answer. Clear? Is it clear? Any question? Is it okay?
Okay, sir.
So, what's the answer? What is the answer?
So that is 906.31.
Sorry?
906.31.
900?
6.31.
Others?
So 990 since 70.
Sorry, 990.
90.
Exactly.
990 since 75.
Yes, for me, this is more realistic. Say, if you just take this 1,000 rupees,
Yeah, that is correct, sir.
discount by 6% just for 2 years, this is about 50, more than 6%.
Yeah, that is correct, sir.
So, others, have you got the same answer? Or it should be 997.7625. So in this type of calculation, better the pricing for the fourth or at least 4 decimal places. Because this is 4,000. When it comes to million or billions, you might see the difference. You calculate this for 100 face value. That's what we generally do. It will be 99.07625. But if you chop this out, you take the prices as 9907 as a percentage, then you calculate, say, for 1 billion face value gold, what is the consideration? Get something like this. But if you had this, get 625, so the difference 625,000. It's not a amount that you can neglect. Okay.
If we write that,
Yes, go ahead.
if we write that 75, do we get reduced marks? No,
Yes.
1 mark.
Say if you write this as 75, you lose millions, not thousands. Okay, is there any other way that we can do this calculation? Easy.
We can use formula.
Yes, what is the formula? This is also a formula, but this is the formula based on the fundamentals, or the basic concept. But you can use another formula. What is it? What is the formula that you can use? So if I ask the question for 12 years, instead of 2 years, if I ask, this is a 12-year bond, do this. Are you going to do this discounting of each and every cash flow for 24 cash flows? Because 12-year semi-annual, there will be 24 cash flows. You can do that, but it will take long time. What do you do? What is the easy way?
Annuity.
Use the annuity equation. So what is the annuity equation? How do you calculate the present value of an annuity? What is an annuity?
So equal cash flows are received from the starting from the 1 year from now.
Yes. Equal cash flows at
So
the
1 year from now.
end of the
End of the-
period. It can be 1 year or semi-annual or monthly, but in equal distance. So evenly distributed for a particular for a finite period. It is not for a infinite period. If it is for an infinite period, what we call it?
Perpetuity.
Perpetuity. Okay. Now, in a bond, there are finite number of cash flows. There's a given maturity and equal for the same amount of cash flow than this. But this can be broken down into two parts. So we we have 30, 30, 30, 30. So whatever the coupon payments, we can consider it as an annuity. What is the equation to calculate the present value of an annuity?
So cash flow into
Sorry?
cash flow into 1 minus 1 divided by 1 plus r to the power n divided by r.
Cash flow into
1 minus
1 minus
1 divided by 1 plus r to the power n
1 divided by 1 plus r to the power n.
total divided by r.
Sorry?
The total bracket divided by r. Total amount.
Divided by r. So I can write it like this. Correct? Is it correct?
So r divided by mean that has to come down of the inside bracket.
Inside bracket to be like this. Without this part.
Yeah.
Same thing. Okay, this is correct. This is the equation for the present value of an annuity payment. Now tell me what is CF, what is R, what is N. That's the other important you should know. What is CF?
Semi-annual coupon payment.
So in general annuity, it's the annuity payment, cash flow amount. What is R?
Yields.
Yields.
Yield or the interest rate. Can't say yield. You can't say just yield. That is the applicable interest rate for the payment period. If you say yield, it's annual, but you can't use the annual yield rate here. What you should use? If it is semi-annual, you should use the semi-annual rate. If it is monthly, you should use the monthly rate. Okay. Even annualized rate divided by 12 or divided by 2 or divided by 4, depending on the frequency. What is this N?
Periods.
Number of periods or number of payments. Okay, fine. Now this is the equation for the to calculate the present value of annuity. But now here our target is to price the work. Is it enough?
Discount the capital.
Now we need, if we use this one, we'll get the present value of these coupon payments only. But we need the present value of the maturity proceeds or the face value. So we have to add this part as well. Face value divided by 1 plus r to the power. Okay, now in this instance, what is the value of CF? What is the value of CF?
30.
30.
30.
What is the value of R? It is
See,
0.5% divided by 2. That means 0.0325. What is N?
Four.
So that's it. Substitute these figures to this equation. Write the answer. So in the exam, would be better if you have to use this. You are going to use this equation. This one or follow this method. Note down these things. Summarize this. What are the information given? Okay. Whether you draw this or not, it's okay. Calculate the coupon payment. So again, you can write it as face value coupon rate divided by coupon frequency, then substitute the numbers and calculate. Then if you are going to use this equation, write it down and better define what are those terms. At least if not, then summarize like this. What is the cash flow? What is R? What is in? Then substitute these numbers into this equation and write it. Then do the calculation in your calculator and write the answer. Then whoever, anybody can see that you have the understanding what you are. Clear? Any question? Is it clear?
Okay, sir.
Okay. Then we'll move to the next part. Part B. Explain the assumptions in yield to maturity. What are the assumptions? That's a theory. What are the assumptions?
So excuse me.
Yes.
I have a question. We can use either this computation method or the previous one we explained.
Yes.
Either.
Either. If it's not specifically asked.
Okay, sir. Thank you.
Okay. So the second or part B is explain the assumption in yield to maturity. What are the assumptions? What are the assumptions in yield to maturity?
So bond is held until maturity.
Bond is held until maturity. That's the first assumption. The second one,
Interest payment are made on schedule as
sorry, interest payments are
made as scheduled.
It's not an assumption of the YT, yield to maturity. But there is an assumption with regard to the coupon receipts. Yes. What is that?
Coupon rate will not change. I don't know whether it depends on the security itself.
It's yes. That depends on the security itself. So coupon rate won't change if it is a fixed rate.
Yeah.
Won't change. It's not the assumption here again. That's the characteristics of the bond. If it is a fixed rate coupon bond, it's given, it's fixed. If it is a floating rate, not only the coupon amount will change.
So cash flows are received in the equal payments.
Cash flows are
It are received on the similar periods. That should be 1 year, 1 year every year.
that is also again the depends on the terms of the bond. If it says semi-annual, it's semi-annual.
Expected rate of return will be same till maturity.
What do you mean by that? That's the yield to maturity. That's what.
Yeah.
That is yield to maturity. That's the expected or the what we think this is the return. But to realize that return, we have to fulfill 3 conditions.
Reinvesting.
You have to reinvest cash flows at what rate?
Same rate.
Yes. The first thing we assume that we hold this bond until maturity. The second is we reinvest all the coupon payments at the same rate for the remaining maturity of the bond. What does it mean? The coupon, say this is a 2-year bond. The coupon we receive after 1 year period, we should be able to invest for another 1 year at the same 6.5 rate. To do that, there should be another thing, another assumption that we, what is that we assume the yield curve remains flat for each maturity. That's why we will be able to reinvest cash flow for a 1 year period at the same rate. Even the last coupon, not the last, the one before the last, for a 6 month, still at 6.5. So we assume the yield curve remains flat during the period. Those are the 3 assumptions in the YTA.
But Mr. Nishant, now even if we don't reinvest, the percent value that we arrive at the moment without still fine. No, it's same. No?
It's the same. It's same. That's the present value.
Only thing is we think about the reinvestment to see whether this is a profitable or will it give us a gain or loss at the point of reinvesting.
No, whether we realize this rate at the end.
Yeah, because at a point of present value calculation, we don't demarcate any reinvestment. We think that we are getting the coupon. That's all.
Yes, that's all. Yes. Shall we move to the next part? Or do you have any questions?
We'll move.
Okay. What's the answer for this? What is the duration of this bond if it is a zero coupon bond?
Maturity.
Sorry,
Maturity check, no?
what do you mean by maturity?
In the sense, no, we don't get in intermediate cash flows, no. So we are getting the cash flow at the point of maturity.
Correct. Now, what is the duration?
Duration is the same as the bond's duration.
So that's what I asked. What is the bond duration? But the duration
But this
of the bond.
one,
Yes. If
2 years.
it is a zero coupon bond, what is the duration of this bond? It is 2 years. Yes. Since it's a yes. Since it's a zero coupon, so you know that for a zero coupon bond, duration is same as the maturity period. So in this case, maturity period is 2 years. So therefore the duration also 2 years. That's all you have to write. You write 2 years. That's it. Even no need any explanation. But if you really need, you can write that explanation since it's a zero. Or for zero coupon bond, the duration is equal to the maturity. So therefore 2 years. That's it. 2 years is enough. But if you really need, you can give that justification. So is it okay? Shall we move to the second part? Any questions? The second part, you have also purchased a 182 treasury bill, 182-day treasury bill, face value of 1000 at a rate of discount of 5.25. Day count basis is 364. Calculate the price paid for the treasury bill. Can you do that? It is a bill calculation. Part A is basically bond calculation. Part B is bill calculation. Face value 1000. And 82 days. Discount rate. What is the price? What is the equation for the price, or the showing the relationship with price, face value, discount rate, and the maturity period. What's the equation? If you want to use the equation, you don't want to use the equation, but you just go by the concept, still you can get it.
That is future value into
Sorry?
future value into
Hmm.
1 minus discount rate into days to maturity.
There should be a
Into
bracket.
days to maturity, sir. No, discount rate into days to maturity divided by 364.
Divide by
That
3.
part divided by 364.
Divide only this part. So the bracket goes like this. Correct?
Yes, sir. Correct, sir.
Yes. This is the equation. If you want to use the equation. So now, what is the discount rate? Given. Days to maturity given by this 364. Indeed, this is the day count basis. In this example, it is also given as 364. So just substitute the figures. 1 minus 5.25. Remember, should be in decimal place, otherwise divided by 100. Days to maturity 182 divided by 360. What's the answer?
$973.75.
973
75.
by exactly what there are few more decimals.
So that is exactly.
Do you still have a connection problem?
No, sir.
No,
No, sir. Now okay.
Okay. Are there any more decimal places? For exactly 75.
No, sir. That is exact.
Exactly. Okay. Okay, this is the answer for the part. This is the price. Or else, if you cannot remember this, what you can do, calculate what is the discount. 5.25 is the discount rate for a one year period. So that is the discount for a 1 year. You get 52.5. Then, but this is 182 days. That means whereas there are 364 days per year. So then the discount should be half of this. 52.5 divided by 2, 26.2. So this is the discount. This is the face value. Then the price is face value minus discount. So you get the same answer. Okay, now the second question, calculate the yield of the investment. Calculate the yield of the investment. What is the yield? What is the yield? Again, there are two ways that you can do this, but once you calculate the price, the easiest way is calculate the yield. Is the base value minus price divided by price and adjust for the time. Number of days into 360. Yield is calculated based on the price that we pay and what is the difference or the earning that we get for that. So basically this is the discount, that is 26.25 divided by 96.75. 960. $973.75. That's the price. Number of days 182. 360. You should get an answer slightly higher than 5.25. Correct? This is the easiest way. Is it correct?
So can you explain that how to get that 26 point? Sorry, thanks. I got it.
That's the face value minus price. 1000 minus 973.75. This is the answer for the previous part. Okay, that's it. Okay, what's the other method? There's an equation showing the relationship between yield and discount rate. You can remember that, you can use it. Then what you have to substitute the discount rate, number of days, day count basis only. But once you do this, I think this is the easiest way. That's a that yield and discount rate relationship is bit confusing or the big equation. Is it okay? Shall we move to the next question? Question number 3. It's about foreign exchange. So first, you are given two exchange rates: euro-dollar exchange rate and the dollar-yen exchange rate, and ask you to explain what is direct quote and indirect quote, and use these two examples to explain it. What's a direct quote? Okay, simply tell me euro-dollar, dollar-yen exchange rates. Which one is direct quote?
USD JPY.
USD JPY is the direct quote. So if it is a direct quote, how do you define it?
So base currency is going to be the USD.
When the base currency is US dollar and we give the value of $1 in other currency, then it's the direct quote. Then euro dollar is the indirect quote example. In that, dollar becomes the counter currency. So that's it. That's the answer that you have to give. What is the exchange rate of euro JPY rounded to 4 decimal places? Now what you have to do, calculate the cross rate euro JPY. How do you do that?
Multiply.
Just multiply, because one is direct currency, one is direct quote, other one is in indirect quote. To calculate the cross rate, what you have to do, just multiply these two. 1.2257 into 108.59, then rounded to 4 decimal place. So having said that, so then you should know, if it were two direct quotes, how do you calculate the cross rate? If it was two indirect quotes, how do you calculate the cross rates? In both it's a division, but you should know which one in the numerator and which one is in the denominator. And then when the bid and offer both are given, it is a cross division. That is also something that you have to remember. So let's move to the next question. Okay, to answer that question C, you need the answer for the question B. A dealer quote euro JPY rate as 133.2552. Determine whether there is any arbitrage opportunity. Explain your answer. Okay. What is the answer for the previous question?
$133.987.
Sorry?
133.0987. 988.
988. Yes. 133.0988. So 133.0988. 0.0988. This is the rate that you get. Calculation. What is the dealer's code? 133 2552. This is the dealer code. Is there any arbitrage? Is there any arbitrage? Just to explain how do you get this? This is 1.22 something into 108 something, the two exchange rates given. What are those? 2257 into 108 5. Then you get this. But this is the rate the dealer is the dealer has got. Is there any arbitrage? The question is whether there is any arbitrage. You should
So you can buy and sell.
Again, answer the question. Determine whether there is any arbitrage.
Yes.
Yes or no. Yes,
Yes.
or no. Yes. The answer is yes. There is an arbitrage. Explain why. Explain your answer. Now you have to tell why. What is the reason for there is having an arbitrage? Why do you say yes? If you say no, why? That's it. Why do you say there's an arbitrage?
You can
Quoted
buy.
rate is higher than the market rate.
The market or the dealer quote is higher than the market implied rate. Based on the given exchange rates, implied rate is 103.0988, whereas the dealer quote a higher rate. There's a difference between these two. So therefore, there is an arbitrage. That's it. Remember, in that discussion, it's not asking what you should do to explore this arbitrage or nothing. The question is whether there is an arbitrage. If yes, why? If not, why? So explain. That's it. So what you have to say, there's a difference between implied cross rate and the dealer's quote. So therefore, there is an arbitrage opportunity. That's it. Clear? Is it clear?
If the dealer's quote is lesser than the other one, answer is all the same.
Yes. If this is the dealer's quote and this is the market implied rate based on the given exchange rate, is there any arbitrage? Yes or no?
Yes.
Yes. Still there's an arbitrage. If the implied rate, if there's any difference between implied rate and the market rate, there is an arbitrage. If you ask, explain, maybe the if you ask to explain what are the trades or what do you do to explore this arbitrage opportunity, then only you have to tell, okay, what do you do here? I think the next question is about that. However, what do you do here? There's an arbitrage. Now what do you do if you want to explore this arbitrage opportunity, make that profit?
So buy from the market and sell it to the dealer.
You can't
Buy euros.
You can't buy from the market because dealer is the market. This is the market implied trade only. What do you do?
Buy euros.
Buy euro.
Buy euro. Yes.
Okay. Then
Sell to the dealer.
buy euro against what?
Yes, JPY.
At what rate?
133.0988
From where?
from the market.
So the market is the dealer. There's nothing
From that.
for the euro JPY, when you ask from the dealer, this is the code that is given to you. This is the implied rate based on the euro dollar exchange rate and the euro dollar, euro dollar and dollar JPY exchange rate. Euro USD exchange rate is 1.2257 in the market. USD JPY is 108.59 in the market, and the market, the dealer on the euro JPY. This is the implied euro JPY from these two exchange rates. What do you do? Out of these two rates, which one is high?
Dealer's rate.
Dealer's quote is high, so it's expensive. So what do you do? In the high market, what do you do? You sell. So call the dealer and tell them, the dealer saying, so you selling euro against JPY at this rate. So now you have to pay euros to the dealer. How do you find that euros? Go to the
So
market.
sell dollar and buy euro.
Yes. Go to the market, sell dollars and buy euros at this rate. Sorry, here you want to sell euro. So therefore you want to buy euro. Go to the market, sell dollars and buy euros. It's fine, but how do you get dollars? You have to buy dollars against JP. Go to the market, buy dollars against JPY at this rate, use those dollars to buy euros at this rate. That means effectively you buy euros against JPY at this rate, 133.098, whereas you sell euros against JPY at 133.2552. So the difference is your profit. You sell euro JPY at that rate, this rate, then buy dollars against JPY at 108.59, then buy euros against dollar at 1.2257. Use those euros to pay the deal. So you go through a cycle without investing any cent, you can make the difference as the profit. If you move to the next question part, you observe that 1 month for GBP AUD is overpriced in the market. What trades will you carry out in the market to make the arbitrage profit? So the same question. But it's in a forward. 1 month forward, GBP AUD is overpriced. So 1 month forward price. The price is not given, but it says it's overpriced. What does it mean? It is overpriced 1 month forward. If you take the currency pair is GBP AUD. If you take the spot today and the interest rate of these two currencies, you can calculate the 1 month implied forward rate based on the spot rate and the two interest rates. So market forward rate is overpriced means the market forward rate is higher than this implied forward rate. So this is high, this is low. Then what do? Enter into a sell transaction. Sell GBP AUD. So you agree to sell sterling against dollars in 1 month's time. There's an arbitrage. So how do you cover this position? Since you agreed to sell GBP in 1 month's time, you need a GBP flow in 1 month's time, and you will receive AUD. What do?
Sell AUD and buy USD.
Yeah.
At the forward market.
At the spot market, you sell AUD and buy GB. Correct? That's what you said. You sell AUD
So
and
buy
buy
USD, sir.
USD. Why do you need USD in this case? This is about forward. This is not about triangular arbitrage. This is interest rate.
Oh, okay, sir.
No dollar involved. Whatever this, because the forward rate is higher than the implied forward. So you sell GBP and you receive AUD after 1 month. So to sell the GBP, you need GBP in 1 month time. So what do you do in the spot market? Indeed, first step is you borrow AUD for a 1 month. Today, at this point, time 0, you borrow AUD for a 1 month period at this rate, whatever the market interest rate. Then you sell those AUD against GBP. You buy GBP AUD at this spot rate. Then you get sterling at the spot. Then what do you do? Lend GBP for a 1 month. Then what would happen after 1 month? You receive GBP principal plus interest because you had a deposit or whatever. You receive the principal plus the interest. Not only that, you had this obligation. You agreed to sell GBP. So, pay GBP, or you can say sell GBP, and what do you receive? You receive corresponding amount of Australian dollar. So then, whatever the receipt of GBP will be cancelled out. There may be difference in the, but you receive AUD. Then what do? You use this AUD receipt to pay the borrowing in AUD. The very first one, you had the obligation. You pay the borrowing in AUD, again the principal amount and interest. Once you do all those things, there should be a balance in AUD. You should be able to earn the profits in AUD. Only whether you realize it in GBP or AUD, that depends on the notional amount you select. So for the question D, these are the things.
So can you please explain once again these steps?
Yes. You have the spot market exchange rate and the two interest rates for 1 month. So what the question says, the market price for 1 month forward market price is high. That's what does it mean by overpriced. Compared to what? Compared to the implied forward rate. What is this implied forward rate? How do you calculate this forward rate? Spot rate 1 plus interest rate for the counter currency and 1 plus interest rate for the base currency, and adjusted for the number of days. That part is there. So this is the forward rate, implied forward rate, interest rate parity. So if this rate is less than the market rate, that means market is overpriced. So what do? You sell GBP AUD. This is also at time 0. You have to write this one as well. Sell 1 month forward at the. So first thing you do, you sell the forward contract. Do you agree to sell GBP against Australian dollar in 1 month's time. Once you enter into this transaction, you have an obligation to pay sterling pound in 1 month. How do you find it? What you do, you go to the market, borrow AUD. Why do you borrow AUD? Because after 1 month's time, when you sell sterling, you receive AUD. Then you can use that AUD to pay your borrowing. So therefore, you borrow AUD at time 0 today at this market interest rate. Borrow AUD for 1 month. Why 1 month? Because that's the time period of the forward. Borrow AUD for 1 month. So you borrow Australian dollar today. Now you have Australia. What do you do? You don't keep it. You sell that Australian dollar against GBP, or in other words, you buy GBP against Australian dollar on the spot market. So then you sell AUD and buy GBP in the spot market. Then you receive sterling. What do you do then? You need that sterling pound not today, but in 1 month. What do you do? Until such time, you make a deposit at this rate. Then you pay interest rate on Australian dollar and you receive interest on GB. On the maturity date, that means after 1 month, what you have to do, you receive your maturity proceed of your sterling deposit, principal and interest amount. Use that sterling amount to pay for your first transaction because you entered into agreement to sell GBP in 1 month's time. So you sell or you pay that GBP and receive the equivalent Australian dollar amount based on the exchange rate in the applicable to the forward transaction. You receive a Australian dollar. You can't keep it because you have an obligation to pay for this lender because you have already borrowed Australian dollar for a 1 month. So use these Australian dollar proceeds to pay that borrowing. Then when you see this, you will see there's nothing left. But if you put numbers into these, there should be something, difference between what you pay in Australian dollar and what you receive in Australia. That difference is the arbitrage profit. Without investing any cent, you earn that difference. That's the arbitrage profit. If you can remember, we discussed two arbitrages. Are those? Indeed, we discussed 3, but the first one generally we don't explore that in, say, for the same currency pair, if 2 different parties quote at 2 different rates, you can buy from one and sell to another, maybe due to mistake or something like that. But broadly, we discussed triangular arbitrage and this interest parity. The triangular arbitrage is the question in the part C, where you we have three currencies: Euro, USD, JPY in the previous question. This involves cross currency. If there's any differences in three exchange rates for three currencies and three currency pairs, same currency pairs, Euro dollar, dollar yen, and Euro JPY. If there's any difference, then it is a triangular arbitrage. In the interest rate parity, it is the difference between implied forward rate and the market forward rate. What is this implied forward rate? It comes from this equation based on the interest rate parity that depends on the spot rate and the two interest rates of the two currencies. If there's any difference between implied forward rate and market forward rate, again there is an arbitrage opportunity. To explore this one, these are the steps that you have to follow. Borrow in one currency, convert that currency into the other currency in the spot market, and lend that received currency, and do the forward market transaction. Whether you buy or sell, that depends on which one is high. The implied forward rate is higher, with the market forward rate is. But in a triangular arbitrage, what you do, you do three transactions in the spot market. Buy Euro dollar, then buy dollar yen and sell Euro JPY, something like that. Again, that depends on the relationship between the implied cross currency rate and the market cross currency. So I hope you can remember this. We discussed this all these things with a few examples. So shall we take a break here?
Okay, sir.
Okay, sir.
Okay, we'll take a 15-minute break. Again, after break, get ready. You come up with what you want to do. I think we finished the third question. Fourth. Then fifth and sixth question, I think maybe Saju discuss this, but the same concepts that you discuss in this regulation part. This is about ALM, the question 5. So think whether we want to discuss. I'm not going to discuss this last question. However, if you need, I can give a briefing, but not the lengthy discussion. This is the topic that you discussed last 3 weeks, or else we can discuss the MCQ questions and the true false questions.
So excuse me, is there a possibility for us to get another 1 or 2 past papers from the institute?
I don't think so.
Oh, okay. Not available, no?
Sorry, yes, not available. But you have the questions that I gave to you. And the thing is, in the, before this 2020 paper, there wasn't a question on regulation part. The meaning that in the essay, if it was there only it was only a sub question, or a part of another question. But since last year we included a separate question on regulation, even this time you are going to do the same. So yeah, that's why even it is available referring past papers before 2019. It won't help that much. And there are some topics we discussed in those years which we couldn't discuss this year. Someone didn't have time, or there are some differences as well.
So is there opportunity to know the marks allocation on the module wise? Can we have the mark allocation for the regulation and compliance? We will having a 20 marks question. Likewise for the other 5 and
in this one also we'll try this one this time to segregate, but in all other questions you can see for each part the allocation is given. Say the last question we discussed, question 3, just to explain direct quote and indirect quote 4 marks, calculation for the cross rate 5 marks, then identify whether there's an arbitrage or not 6 marks, and explaining this 5 marks. Sure, yes, 5 marks. Likewise, even in the previous one, calculation the bond price 5 marks, for the explanation of assumption 5 marks. So breakdown is given.
So for the treasury management, for the asset and liability module, and for the treasury management function, what type of marks allocation will be there?
Again, there will be a 20 marks question. So even this time, the question number 5 is on that.
20 marks means for treasury management function 10 marks and asset liability management 10 marks, like that?
No, it can be a combination. It's not necessarily 10 and 10. Maybe liquidity management, ALM only, or treasury only, or maybe a combination of that. But so that is only in the part B. There can be more questions in the first question as well, relevant to this.
So for the risk management, how much like we can expect for the 10 marks or?
So risk management again. So maybe if you go back this arbitrage and things or hedging, those things will be incorporated into, say, we want to discuss say the question number 4. This is about part of risk management and derivatives, a combination. So it will go like that.
It's
for
a, will be,
foreign exchange, forward, and risk management in foreign exchange. That's how it goes.
like the regulation and compliance one, there will be not a separate one. There will be a combination of this one, no?
Regulation compliance, yes. Again, like this question number 6, there will be a question.
No, I'm asking for this one separately for this regulation module. There will be a 20 marks separate, you know. So likewise, we can't get for other one. We can't get separate. No, there will be a mixed type of things.
Yes,
no?
yes. Say risk may be in a combination of fixed income or the foreign exchange or derivatives, because you can't do that alone.
Yeah. So more weightage will be given to the financial market and for the financial derivative markets, those two modules.
That depends on the mostly in proportion, mostly, not exactly, but based on the weights given in the for the number of hours. So basically, we spend more time on the market product, fixed income, FX, money market. There will be a weight on that also. The time you spend on ALM and Treasury and regulation.
Okay, so thanks.
Okay, shall we have a break? About 15 minutes. So we'll take a break here and come back in 15 minutes. Say, yeah, 11:15. Shall we start?
Okay, sir.
You can. Can you see the window or the paper?
Yes, sir.
Shall we start from section 1, section A?
Okay, sir.
Okay.
Any particular question you want to discuss? If not, we'll go in order.
So number 8, if possible, can you go through all or?
This one.
Yes.
Transactions in OTC market carry lower credit risk compared to transactions in exchange market. Is it correct or false? True or false? What is OTC?
Over the counter.
Over the counter. So over the counter market transactions carry lower credit risk compared to transactions in exchange market. Is it true or false?
False.
False. Why? So you have to say false, then give the reason. Your reason.
Counterparty risk is high, sir. Settlement risk.
OTC market is just between two parties, so therefore the credit risk is high in the OTC market, but in the exchange market it is between or the exchange is there. So therefore the credit risk is low in the exchange market. That's the answer.
In the exchange market can happen over the counter also. That means foreign currency
No, that's not the
between Indians doesn't happen.
exchange market means where you trade through an exchange. Over the counter market means just between two parties.
I thought that is exchange, foreign exchange, not that.
No.
No, that is exchange. Okay.
Anything else? Any other specific question?
So number 10.
This one, I think. Did we discuss value at risk? I think no. In the market risk, we couldn't discuss value at risk, so therefore you may not be able to answer this question. However, the value at risk is the maximum loss that we expect within the given confidence level. So if it says 95%, that's the maximum loss that we expect when we say 95% confidence level. Then there's a chance of 5% that the loss will exceed the given number. So out of 20 days, 1 day that can exceed that limit. That's the basic idea. So why is or the value at risk is defined as the maximum loss that a portfolio may incur during a given period with the given confidence limit. However, don't worry about in the exam. You will not get any questions on the value at risk. Anything else? Sorry?
12.
Which of the following is not a limit to control market risk? Which one?
So D, sir.
Counterparty limit. Yes, counterparty limit is to control what risk?
Credit risk.
Credit risk.
And 13, sir.
13, a dealer at bank A sells $JPY 10 million to bank B, and the chief dealer of bank A sends the confirmation of the transaction to bank B. Then is that action correct or incorrect? If it is correct, why? If it is incorrect, why? Give the reasons. So is it correct?
Incorrect, sir.
Incorrect.
Incorrect. Why? Who should send the confirmation?
Back office.
Back office. So now go through the answers. You can omit A and C. This is incorrect because confirmation should be issued independently by the back office. That's the answer. Answer B. Clear?
You mean that person who is the dealer can't issue the confirmation?
Dealers cannot send the confirmation.
Only he can give the rates.
Confirmation should be sent by the back office. Dealer can agree to the transaction.
But then it should be definitely confirmed by the back office, the middle office.
No, confirmed by the back office, not by the middle office. Middle office is there to just to monitor the controls and risk.
So if that back office
Middle office generally does not communicate with outside. It is only internally. Back office is front office communicates with the front office of the other or your counterparties. Back office communicates with back office or outside with the outside parties.
So that means until that back office confirm the transaction, it is not valid. Is it the case? It is confirm that it will take place.
The settlement won't take place unless the confirmations are matched and come to a conclusion. This is a done trade and the terms and conditions are matched.
So that can that happen even that dealer agrees to a certain rate and conditions, but
sometimes that can happen. So due to errors or omissions, negligence, so that sometimes that dispute can occur. Then
that means the dealer has
both parties has to.
That means a dealer has quoted the wrong trade, something like this.
Maybe. Or maybe not got the wrong code. Maybe entered the wrong rate into the system.
If they have entered the wrong rate, can the back office correct that? And
No.
do the process?
No, back office cannot correct it. Then the deal should be sent back to the front office to amend it.
So until the back office confirm the transaction, the other party cannot is not sure of this transaction taking place.
Yes. Whether it will settle or not, that doubt is there. Even you confirm there's uncertainty whether the transaction will settle or not, but the confirmation, independent confirmation from back office should be received to make sure that transaction is a proper transaction.
But to confirm that by the back office, it will take some time, isn't it?
No, that should be sent immediately. That's why you have the front office. Whenever you dealer enters into a transaction, he or she should immediately enter in if there's any system to the system, and it will go to the back office. Nowadays, back office if the system is properly set up, the confirmation will be sent automatically without any involvement of back office persons.
Okay.
If there's any mismatches in confirmation, receiving confirmation, and the trade enters by the front office, then back office people have to investigate and contact the back office of the other party, see where the thing has goes wrong and rectify. Maybe you may have to ask the counterparty to amend the confirmation, or maybe the front office, your front office, to ask to amend the deal.
Okay, sir.
But yes.
25, sir.
One-year interest cost is 7%, while dividend payment is 5%. Stock index is the 1-year futures price would be. So the current spot price is, the stock index value is 11,000. Interest cost is 7%. Dividend payment is 5%. So it's about futures. What would be the futures price? Not the exact figure, whether it's 11,000 or below 11,000 or above 11,000, or whether you need more information to decide it.
About 11,000, sir.
Above 11,000. Why?
Carry cost is high, sir.
Carry cost is high. The carry cost is, or the interest cost is 7%. You have a benefit of 5% dividend, but still net cost is 2%. So the carrying cost is high, then the futures price is high. So see the way that the question check your understanding on the concept. So there will be a lot of questions like that, especially in the MCQ. That's why I personally prefer to have, if we can give the whole paper in this question sort of, or the MCQs to the point. Is it clear? To answer this question, you should remember the cost of carry model. Current price, then you add the cost of carrying the position and deduct any benefits. So whether the spot price is, or the futures price is higher than the spot price or lower than the spot price, that depends on the net cost of carry, whether it's positive or negative. If the net cost of carry is positive, futures price is higher than the spot price. If the net cost of carry is negative, then the futures price would be less than the spot price. You may remember we categorized them two different markers, backwardation and what are those two markers? Backwardation and contango. So you should remember. Is it clear?
Yes, sir.
Okay. Any other question or anything else?
The 26 also 10.
Primary reason for not having a haircut requirement in a report transaction now. Sorry, primary reason for having a haircut. Why do we have a haircut in report? Is it for a counterpart? Is it for counterparty and operational risk, or counterparty risk and legal risk, counterparty risk and collateral illiquidity, and legal risk? Why do we need haircut?
So that is C.
See, counterparty risk and collateral illiquidity. Counterparty risk is if the counterparty defaults, we can get that collateral and recover it. If the collateral is liquid when you are trying to sell it, you may have to sell it at a lower price. So then when you have the haircut, it will give you enough recovery to cover the lend amount. So, but having haircut or the collateral, it will give you, you will expose to operational risk. You have to calculate the haircut properly and then ask the counterparty to place the collateral properly. There are some operational activities additional, so that will introduce operational risk, legal risk as well, whether the pledged security is unencumbered or whether you can acquire that collateral immediately or not. So that will give rise to legal risk and operational risk. Any other question?
So it's then the answer is the legal risk and the operational risk.
No. So ask why do we need this? Primary reason for having a haircut? That's the question. So the reason we have is to cover the counterparty risk and the collateral. Having collateral and haircut, it will give you operational, increase your operational risk and legal risk. So introduce. Then you have to have a proper controls on that operational risk. You have to cover that one. Any other question?
The 24.
When we borrow funds for 6 months and lend them for a 1 year, we make a profit if you borrow for 6 months and lend it for a 1 year. So what is the gap? And what do you expect? And when do you make a profit? You have a short-term liability. You borrow funds 6 months means you have a short-term liability and a long-term asset. Then for a 1 year period. What is the risk? So what is the gap? Negative or positive?
Negative.
You have a negative gap. Then what is the how do you make a profit when the gap is negative?
Interest falls.
If interest goes down. So the answer is A.
Sir, can you explain 29 just to not 20, 29?
If you accept an overnight deposit, $10 million on Friday at 0.5%, what is the principal plus interest payable, repayable at maturity? It is overnight deposit, but taken on Friday. Then what is the maturity date?
Monday, sir.
Monday. Then how many days? For the interest calculation, you need the number of days. For how many days do you calculate interest?
So 3 days.
Sorry?
3 days.
3 days. So then that's it. That's the point here. So you know how to calculate principal amount into number of days into the interest rate divided by the day count basis. But generally, when you say overnight, it is only 1 day. But this is the settlement date is Friday. So then overnight will go for 3 days. So you have to calculate the interest for 3 days. 10 million into 3 divided by 360 multiplied by 0.5. Million into 1 plus 3 divided by 360. Interest rate plus 0.5%. 0.5%. That's the answer. So you can see it checks two concepts: how to calculate the interest and how do you decide the maturity rate. Clear?
Yes, why 360 was taken because of that 18?
For the dollar, that's the convention.
For the dollar. Okay.
So can you explain 27?
The maximum risk from selling a futures contract is, what is the maximum risk if you sell a futures contract? What would happen? When do you make a profit? If you sell a futures contract, when do you make a profit? If you sell a futures contract, when do you make a profit? When do you make a loss?
Which price goes up.
If you sell a contract and price goes up, what would happen? You make money or lose money.
So when the underlying asset price is low, you make profit.
Yes. So you sell the futures contract, then futures price goes up, whether you make money or lose money.
Lose money.
Lose money. So the question is, when do you? Oh, so that's the what is the maximum risk? So what is the maximum risk?
Unlimited.
Unlimited. So if the price goes up to infinity, whatever the difference that you have to pay, what is your selling price and what is the current market price, that difference you have to pay. If the price goes up, that's the risk. That difference is your loss. So it's unlimited. It's same as if you you short sell any asset. If the price goes up, you are losing, and it's unlimited. Correct?
Correct, sir. Thank you.
Any other question?
So 37.
37. They are, if I remember, they are 37. Okay. A 5-year government security carrying a coupon rate of 7% is currently trading at a yield of 6.85%. If you are to buy this bond, you would expect to pay face value of the security more than the face value, less than the face value, too little information to decide. It's a 5-year government bond.
Less than the face value.
Coupon rate is 7%.
Less than the face value.
And the yield required is 6.85.
Less than the face value.
Less than face value. Why?
Coupon is 7. The return rate of coupon return is higher than the yield.
then
It's a discounted one, not a premium one.
any others? Are you in agreement with that, or what is the relationship between coupon, yield, and price? If the coupon rate is higher than the yield, price is it above par or at par or below par? Or in other words, whether the bond is trading at a premium, discount, or at par.
So that should be discount, sir.
When the yield is lower than the coupon rate, it should be at a discount.
No, when the coupon is high.
Yes, that's right. Coupon is
Yeah,
high.
Yeah, discount.
Coupon is high, yield is low.
Yield is low, then discount, sir.
Then it's at a discount. Let me check. 5-year government security carrying a coupon rate of 7% is currently. Okay, assume this is an annual. And then can you do the calculation?
No, we need the date, no? Purchase date.
No need, because it's assumed it's 5 years. Assume full 5 years is there.
5 years we are buying at 0.
No, that's the yield is 6.85. Now we have to calculate what would be the price that if you are to buy this bond. Assume the bond is just about to issue or just issuing 5-year bond. Assume it's annual coupon. That's the only information you need if you are to do any calculation. 7% coupon and 6.85 yield. What is the price? Can you do the calculation?
93.58.
How do you do that?
That is only the capital portion I took. Wait, sir.
Capital or the coupon? Oh yes, capital portion.
So that is 100.14.
100 point?
It's a premium bond, no?
14038.
I don't know whether the answer is exactly correct. 100.14 or something. It's correct, but it is a possible correct answer, because when the yield is less than the coupon rate, the bond is trading at a premium. It should be the case. So the answer is, in this case, you pay more than the face value. If you are to buy this bond, you would expect to pay more than the face value. If the yield is higher than the coupon, then it's at a discount. If the yield equals to coupon, it's at par, same as the face value. So
Sir, how that is
no need to do any calculation to answer this question. You should know that relationship. Yes, go ahead.
Sir, how that calculation is done? And
So the same way as we discussed So answer the question number 2. And only either you can prepare the cash flows and discount each and every cash flow and add them, or you can use the annuity equation and the present value of the face value, add them together.
So we have to assume the amount.
In this, to answer this question, you don't have to do any calculation.
Yeah, but to calculate amount, we have to assume amount.
If you want to calculate the sum, you have to assume face value. Yes. Others like
No, no, that's 101 amount. That's how did that come?
That's the general practice. No? We can take
So
100 as the
I
face
took it
value.
as
Okay.
yeah, I took it 100 as the face value and for 1 year.
It's only for 1 year.
Yes, I check for 1 year and then decide the.
It's still the same. Even for a 5 year, it should be the same. If you do
Yes,
the
sir.
calculation.
Yes, thanks.
That's why I mentioned I'm not sure whether the exact figure is correct, 100 point something, but it should be above 100. So I was looking for I think there was a question like that.
So, but if it is face value is about 50, it can't be 100.
Sorry?
If the face value is 50, let's say it's 50.
If the face value is 50, you pay more than 50. So it's still at a premium.
Okay.
Wait. The face value or whether it's a premium or discount decided based on whether it's more than the face value or less than the face value. Not the 100. 100 as a percentage. If you get the price as a percentage, then par is 100. Above par is at a premium. Below par is at a discount. Any other questions? What is the answer for this? Is it true or false?
True,
Yes,
sir.
true.
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 Why?
Is there a difference in the terming, like yield is used to value a bond or current yield is used to value a bond?
Yes.
Yeah, yield is what's used to value a bond. Correct.
What is current yield?
Current market yield.
No. That's the thing. So in general, or day to day, we never say it's what is the current yield. That's the ongoing yield. But technically there's a definition for the current yield. It's just the coupon divided by the price. So that's not the yield that we use to calculate the bond. We use the yield to maturity by TA. Prevailing yield to maturity. But when we say current yield, it is the coupon divided by the price. So the answer is false, and give the definition of the current yield. and it's not the yield that we use to price. The yield to maturity is the rate that we use to price a bond.
So how do we calculate the current yield? What is the equation?
Coupon divided by price.
Okay.
So question number 21, please.
The Sri Lankan company imports vaccine for COVID-19 from India. It will take 1 month to deliver the vaccine to Sri Lanka, and the payment will be made upon the receipts. The consignment, which of the foreign is not suitable to hedge the foreign exchange risk of this firm. Okay. What is the first? Identify the risk profile. So it's a basically import, whatever it is. So there's a 1 month to make the payment. Today you fix the price. What is the risk?
The exchange rate risk.
Exchange rate risk is obvious. What is that exact? That's the problem. Whenever you ask in a question, especially in the essay type question, I can put this same explanation and ask what is the risk faced by the company. Then you have to say the exchange rate risk, partly true. Exactly what?
And depreciation of LKR.
Depreciation of LKR. That's the risk. If rupee depreciate, that means you have to pay more rupees to buy a dollar. That's the risk. Okay, if it is the risk, out of these 4 options, which one is not suitable to hedge that risk? So identify what are the suitable ones, and the rest is, or the remaining one is the not suitable. 1 month forward to sell LKR against USD. Is it okay to enter into a transaction to sell rupees against dollars in 1 month time?
Not a good idea, no?
Not a good idea. Why?
So that is correct. Sell
That is
dollars.
that is
Sell
correct.
LKR mean buy dollars.
Sell LKR against dollar means you buy dollars in 1 month. That is what you need. You need dollars in 1 month. So basically, it is a forward contract to buy dollars against LKR. So that is correct. The second one, 1 month call option to buy dollar against LKR.
That is also correct.
That is also correct. So buy a call option on dollar rupee. FX buy sell swap on USD LKR.
That is wrong, sir.
That is strong. Why?
We buy dollar at now.
You don't want to do a swap. You don't have 2 legs. What you need, buy dollars in 1 month. Whether you buy today or buy in 1 month, whatever you don't want to buy today and sell in future, or sell today and buy future. You don't want that one. You don't have two separate cash flows, 2 legs. So that's the correct answer, because it's asking which is not suitable. Even the last one, 1 month put option to sell LKR against dollar, against it is like buying dollars. So the answer is answer C. Anything else? Is it clear?
So third one, can you explain?
Third one. Maturity date of a 1 month deposit made in the money market on 31st March is 1st May 2021. Is it correct? Whether it's correct or incorrect. You place a deposit value date with the value date of 31st March 2021. 1 month deposit. So when is the maturity date?
Should be the month end, next month end, no?
Next month end, yes. So you don't go beyond the month end. That's the convention. So it should be whether it's 30th April or 29th April, whatever, last business day of the next month. It cannot go or fall into the month of May. So the statement is false. So it cannot move into the next month. It should be the last business day of the following or the corresponding maturity month. March is the deposit month, so the 1 month maturity month should be April. So it should be last business day of the April. See, you can see the regulations and those concepts also appear in the question 1 as well. What's the answer for the question 6?
Rate of return and rate of discount, they are talking about two things.
Yes.
False.
In investing in treasury bills, one can always receive a rate of return in excess of rate of discount. True or false?
In treasury bills, these two are same, no?
Okay, then the answer. Is it correct?
Is it correct? True. Correct.
Or false?
False.
Correct.
False.
False. Any other answers?
Correct.
Right.
Discount rate is considered with the face value, and the rate of return is the price we pay after deducting the discount.
Exactly what we did in the morning. So the same question. So if you go back, if you answer this question, the discount is 5.25. Whenever you calculate the yield, that's the rate of return, you get more than 5.25. So same thing what we discussed in the moment. So the rate of return or the yield is higher than the discount rate, or at least equal. So at least equals means that happens only when it is 0. Only thing that you can argue if the yield is negative. Then
If the yield is
negative, then it will be a different story. But you can write it false or something like that. Then you have to give the explanation in that. If the yield is negative, only this may not. Otherwise, this is always true. This one.
That is true, sir.
This is true. So intrinsic value cannot be sorry. There's a subtle thing here. Always
Positive or zero.
positive. So the question is whether 0 is positive or negative or not. So you can argue this is true, but it's yes. Then 0 is positive. So therefore, either way you can write it false or true. If you say it's false, then you have to say it can be 0 as well. Or if you say true, then you have to say it cannot be negative. So either way, it can be. But sometimes most of the time when you say it's positive, you don't consider 0. So therefore, generally the answer should be false and it can be 0. Intrinsic value can be 0. So it's non-negative, not positive. Either positive or 0. So it's non-negative. That's the general concept. But here, if you can explain that, then you can argue this it as true or false. Either way. But in the explanation, you have to make it.
So even for the true, you need to get the write the justification.
Yes. If you write it true, then you have to write it in that way. But that should include 0 as well. Because it's not mathematics. How do you define positive or 0 or negative? It's the concept that whether you get it can be 0 or positive. That's the value or the idea that we need here. Whether it's technically positive or negative, it's not the case. Hello.
Excuse me, sir. Shall we discuss the fifth one?
Fifth one. Okay. It's about the direction. What's the answer? if someone is not fulfill that qualification, can the bank hire that person or not?
No, sir.
No.
Can that within 1 year that if we can complete, it's okay. The proof.
Yes. That's the correct answer. So can, but okay. The concept is the bank can hire with the managed board approval, I guess, board or the management approval, if I remember correctly. That's the concept. But within one year, they have to fulfill this requirement of it. But if you go back to this statement, can be appointed to engage in treasury operations with the approval of the central bank. Is it correct? It is not with the approval of the central bank, but with the approval of the board, the management of the bank. So therefore, this statement is false.
But sir, if we say like that, within 1 day can be obtained, it still don't get any marks.
So sorry, I didn't get it.
So let's say when we have mentioned that 1 year can be, it is true, and say that he has to complete that one of the qualifications, which is say if we write so, it still we don't.
But the thing is here is asking whether it's can be appointed with the central bank approval. That's the question.
Okay.
So we have to write as false, and we have to write as the approval of the next board.
That can be done with the approval of the board. Or you can say no need to get the approval on the central bank.
Sorry, sir, I didn't hear that.
You can say the bank board can appoint and no need to get the monetary board approval or the central bank approval. You can write it like that.
Okay.
If you really want, you can decide, but they have to fulfill the qualification within 1 year. That is not necessary.
Okay.
Anything else? This one. In an interest rate swap, both the fixed and floating payments are known at the end of period for which they will be paid. Is it correct? It's about an interest rate.
No, sir.
Fixed.
Sorry?
Fixed and floating, both they say, no?
Yes. Whether you know the fixed rate and the floating rate at the end of the period.
Fixed can be known in advance.
Yes. Fixed rate is one. Whenever you entered into the transaction, you know what is the fixed rate for the whole life of the swap. But the floating rate?
At the end.
When do you know that? Is it at the end of the period or beginning of the period?
End is it, no?
Say it's every 6 months or 6 month payment interest rates of when do you fix the floating rate? At the end of the 6-month period or at the beginning of the 6-month period?
So at the beginning, you will fix it.
At the beginning, you fixed it, but paid at the end. The whatever the difference is paid at the end. So therefore, this is false. It's not at the end of the period. You know that at the beginning of the.
So here it's asking not about the rate, no, but about the amount. No?
Whenever you know the rate, you know the amount. Yes.
Yeah, only at the time we know the rate, we know the amount.
Yes. These cross rates you can calculate, I guess. Okay, this one. You receive following quotes on your dollar yen. From which bank would you buy JPY against USD?
And Visa,
B. Why?
they have the highest rate, 58.
What is the highest rate?
103 since 58. Sorry, 103 16. Banky.
Okay. Is it correct? Others? Any other answers?
It should be D,
It should be B. Why?
because bank sell rate we buy, that is 55.
Sorry, bank.
Bank selling rate is 55, sir, 103.55. That is the lowest which we can buy.
55. 103, 55 is bank D, not bank B. What's the answer? D.
D.
The last one.
Yeah.
This one. Any other answers? Okay, what is the currency pair?
USD JPY.
Dollar yen. So at the bid price of a price. At the bid price, what do you do? If you are a price taker,
We sell.
You are a price
bank.
taker. At the bid price, what do you do? As a price
We
taker, sell what?
sell JPY.
Do you sell JPY at the bid price? What do you sell in foreign exchange market at the bid price?
We sell dollar and buy JPY, sir.
So you sell at the bid, you sell the base currency. In the dollar yen, the base currency is dollars. So you sell dollars and buy JPY at bid. At offer, what do? You buy the base currency as a market taker. So in this case, you buy dollars and sell JPY at the offer. But the question asks at what rate you buy JPY against dollar. In other words, the question is asking at which rate you sell dollars again or dollar yen. That means you sell dollars.
So B,
You sell dollars at the bid. So you need the highest bid. So at what rate you sell?
103.52.
103.52. The answer is B. Bank.
So answer is B. Is it bank B? No?
Yes. Now answer the next question, 16.
So that is B.
B. This one.
Yes.
Why?
Because the selling higher rate is 53. As a market.
You are a market maker. You want to sell. You want to sell to the market. You want to sell dollars to the market. What would be your quote?
So you need to give lower rupee to the market. That means.
So then the answer?
So that is 45.
45. Yes. So you want market participants to buy from you. Then you have to give them a lower offer. They will, if you quote these four, they will go for 45. They will buy at 45. They are not going to come and buy at 53. So you have to give the lowest possible offer. Then only they will buy from you. If you want to sell, you have to give them the lowest possible offer. That's the concept. True that you prefer to sell it at a higher rate, but if you want to sell, you want to encourage others to buy from you, then you have to give the lowest offer. So the answer is A. Okay.
Sir, in that case, can't we assume that we, as the market leader, we are offering the highest rate, so that is the best rate?
Sorry?
Since other rates are not given, other banks' rates are not given.
Yes, other banks' rates are not given, but the concept is you want others to buy. So then out of given 4, what is the most encouraging 4? Okay then, shall we stop here? Any questions or any other questions that you want to discuss?
$31, please.
31. When you present value each currency on the asset side and minus the present value of each currency on the liability side, you will derive the banks. What do you derive?
So it's D.
D. Why?
That shows the net exchange portion.
That's the definition of the exchange. You calculate the present value of the all assets in one currency and all liabilities in the same currency. The difference is the net exchange position.
So like for the practice question, that one. So this one also, is there any answer sheet for at least for the this one part A?
Practice questions. Didn't I give you the answers?
No, you gave the answer like that. Do you have answers for this one as well for the only section A for this example?
For this one. Okay. I post it.
Okay, thank you, sir. And for a rough idea, I'm asking for the exam. Is that okay if we spend 1 hour on section A and other 2 hours on the
That's what I mentioned. So that it's up to you. You have to. There are 100 marks. You have 180 minutes. So how do you allocate? 180 divided by 100, 1.8 minutes per question, per mark. So if you get only 1 point for this question, you should roughly allocate 1.8 minutes on this mark, this question. It's up to you. You may not be able to exactly match that, but there can be some questions you can answer within less than 1 minute. There may be some you may need slightly more than 1 minute, or maybe almost 2 minutes. So, but if you go for a 60-40 allocation, then see whether 1 hour is enough for section A to get 40 marks.
And then another one, sir, for this one, how the 100 mark will be received. From that, how that calculation will be done for 70%, because from the exam paper that will given 70%. So
out of that 70% is
that means if a person gets 60 marks for this written exam, from that 70% will be
you get
calculated.
42 for the final. That means
42 for the exam. Thanks, sir.
Sir, excuse me, are we having another revision class closer to the exam?
we haven't planned for that. If you really need, just make a request. We'll think about it and let you know whether it's possible.
Okay, sir. Thank you.
So, like the exam paper for assignments also will be calculated on the same way. 30% will be calculated from the take.
Yes. Anything else?
Excuse, sir. Sir,
Yes.
if you have time, can you do the question number 9 and 10 practice question, time value of money?
I think we did it. Time value of money. Isn't it? Others.
Yes, sir.
So just I cannot remember when, but the videos are available. You can go and refer that. That would be the best. Okay, shall we stop then? Any other question? So then we'll stop here. See whether we are going to have another revision, if possible, only on 12th December. If you really need, just make a request, then we'll consider whether it's possible. I'm sure we'll go in that way.
Should we inform in advance, or will there be a deadline to inform you, sir?
Sorry?
If the revision class is needed, your best time you said is December 12th, no?
Yes.
Yeah, so should we keep
Yes,
it?
make the request early if you need.
Like December 1st week, is it okay, sir?
No, before that, better.
Before end of this month, we can.
Yes.
End of November.
Before end of November means at the beginning of December. There's no difference. Beginning of the month and the end of the previous.
Like the middle of the November.
At least yes. Say 1 week before the end of November. Then even others can plan for that. So let's say November by 20th or 21st.
Okay.
Then we have 2-3 weeks. So we'll do that way. So my advice is focus on what we discuss in the class and go through the sample questions as well and try to understand the concept. Not to remember, but to understand. So the same concept can be tested in different ways. So if you try to remember the answers for these questions, it won't help. But try to get the concept behind that, then it will help. If you go through the sample questions, also there are some tricky questions. Some of the questions, even though everything, even the answers are in figures, you don't have to do any calculation. So the same question I ask in the paper, say coupon is 7% and the yield is 6.35. I have asked or given the answers in words, whether you pay more than face value, less than face value, things like that. Instead of that, I can put some figures. There's so maybe 3 figures below face value, only 1 figure is above face value. No need to do any calculation. You should be able to pick the figure with above face value because the yield is lower than the coupon rate. Likewise, the same concept can be tested in different ways. Just because of there are numbers, don't think you have to do a calculation. Just think and try to get the go follow the fundamentals and try to get the answer. That type of questions will be there. So be ready. Okay, then all the best.
Thank you, sir. Thank you for the support you given during
Thank you.
the program. Thank you, sir.
Thanks for listening.
Thank you, sir.
Okay, thanks. Bye.
Thank you.
Sir.
Thank you.
Thank you, sir.
Thank you, sir.
Thanks, sir.
Thank you.